Welcome to the Deep Dive, your shortcut to understanding what truly matters. Today we're cutting through the complexity of a pretty seismic shift in the healthcare world. UnitedHealth Group, a real behemoth in the industry, has just revealed its updated full-year financial outlook. But it's how they're talking about it and the sheer scale of the challenges they're facing that really demands our attention. Our mission today is to extract the most important nuggets of knowledge from their second quarter 2025 earnings call and the press release that came with it. We're here to help you quickly grasp the company's performance, the significant hurdles in their path, and exactly how they plan to navigate forward.
Exactly. And this isn't just about parsing through a stack of financial numbers. It's really about understanding the intricate internal and external forces shaping a company that impacts millions of lives daily. What's truly fascinating here, I think, is the refreshingly transparent tone set by the leadership. They're openly acknowledging missteps and outlining a very clear, almost self-critical path to reform. It's quite something.
All right, so the big question is, how did they get here? This wasn't just another routine earnings call, was it? UnitedHealth Group actually suspended their 2025 outlook back on May 13th. That's a big deal. Now, they've reinstated it, projecting full-year 2025 revenue between, $445.5 billion and $448.0 billion, and adjusted earnings of at least $16 per share. Second quarter adjusted earnings came in at $4.08 per share. What really struck me was CEO Stephen Hensley's tone. He described this as a period of change and reform, a recommitment to our mission, and an expectation to perform better than we ever have. It sounds almost like, an apology and a promise rolled into one.
Well said. The significance of that tone really can't be overstated. It includes a direct acknowledgement of pricing and operational mistakes. That's pretty blunt language. And if we connect this to the bigger picture, it does signal a real, maybe a cultural shift in how they relate to regulators and, all external stakeholders. They seem to be aiming to be proactively engaged and constructive rather than just reactive. And to really underline this commitment, the company has even retained independent experts, folks like Analysis Group and FTI Consulting, to oversee and assist in reviews of critical processes. Things like risk status, care management, pharmaceutical services. They're even planning annual reports. The first performance measures report due in Q4. That's a level of external oversight we don't always see.
It's certainly a change in tone, but, for a company this size, facing so much public scrutiny, is this transparency truly a cultural shift, or could it be seen as maybe a strategic move to manage perception during a really challenging time? And beyond the internal fixes, what about the broader environment, the challenges they're operating in?
That's a fair question, absolutely. And it's something the market will be watching very closely. Regardless of the motivation, though, the actions they're taking are concrete. And they are operating in a truly challenging external landscape. That's undeniable. They face significant headwinds, starting with what they called a generational pullback in Medicare funding. That was set in motion back in 2023 and is playing out through 2026. Then you have these unprecedented medical cost trends measured in both the intensity of services and their unit prices, compounded by what they term more aggressive care provider coding and billing technologies. Add to that the prospect of contraction in Medicaid and exchange markets, the growing need to invest heavily in new technologies, and of course the ongoing public controversy over practices in the healthcare sector, particularly managed care. It's a perfect storm, really.
Wow, that is a mountain to challenges. Okay, so let's dive into the specific financials. What exactly led to this revised outlook? Where did the costs surprise them quite so badly?
Yeah, the core revelation, the big number, is that UnitedHealthcare's pricing assumptions were, in their words, well short of actual medical costs. This led to a staggering $6.5 billion more in medical costs than they initially anticipated for 2025. Just think about that number, $6.5 billion. It's a misstep so significant it forced them to suspend and then completely reestablish their outlook. So, to break this down a bit, over half, that's $3.6 billion, is in their broad-based Medicare portfolio. About one-third, roughly $2.3 billion, is in the commercial business, and that's split pretty evenly between their ACA plans and the employer business. The rest of the pressure is related to Medicaid, notably due to elevated behavioral health trends. And on top of that, the updated outlook removes about $1 billion from actions they previously planned and reflects about $850 million of other items like unfavorable prior period items from 2024 and some one-time settlements.
That is just a huge sum. Can you maybe give us a more concrete example? Like, how do these accelerating trends play out for someone in, say, their Medicare Advantage plan? Or how does it hit UnitedHealth's bottom line in a way we can really grasp. What specific trends are they seeing in each segment?
Absolutely. Let's take Medicare Advantage, or MA. The company admitted they significantly underestimated the accelerating medical trend when they set up their 2025 bids. Big time. They initially assumed a medical cost trend of just over 5% for MA, but now they expect it to be approximately 7.5% for the full year 2025. And this was made worse by the sheer magnitude of plan exits across the sector, plus providers just placing more service intensity into the health system. This increase in care activity also hit complex populations and their Medicare supplement business. And speaking of Medicare supplement, that business often gives a good read on overall Medicare fee-for-service trends, right? Well, it's expected to see over an 11% trend this year. Compare that to 8-9% in recent years. So that further confirms how broad-based this activity is and the coding and billing patterns they're seeing across the whole system. Then in commercial, they're seeing higher than expected cost increases too, particularly in outpatient care, and a bit less so, but still there, in inpatient care. Things like orthopedic spending and pharmacy infusions are notable factors driving that. Now, for their ACA business, the main cause of underperformance is the revenue impact from a difference between priced and experienced morbidity.
Morbidity. Can you just quickly clarify what that means in this context?
Sure. Morbidity here just refers to the rate of illness or disease in that specific group of ACA plan members. So essentially, they priced their plans based on an assumed level of illness, but the people enrolled turned out to be sicker or had higher healthcare needs than expected. Their group fully insured trend, meanwhile, is approaching 11%. That's about 100 basis points, or 1 full percentage point, higher than they initially expected. And then for Medicaid, elevated trends are really apparent there too. And it's getting further affected by this increasing and unanticipated acceleration of costs in behavioral health. Get this. The trend there is running at 20%, as well as increases in pharmacy and home health costs.
20% in behavioral health trend. That number really stands out, doesn't it? It almost makes you wonder if even giants like UnitedHealth are grappling with a broader societal shift in mental health needs that maybe no one quite anticipated the scale of.
It's a striking number for sure, and they anticipate this rate and acuity mismatch, meaning the rates they're paid by states don't match the severity, the acuity of the conditions they're seeing will extend into next year. So overall, there's just been this marked increase in healthcare costs, driven partly by increases in service intensity per encounter, higher frequency of doctors rounding, more testing, related services in ER settings, things like that.
Okay, so with all these complex and, frankly, escalating costs, what's UnitedHealthcare's game plan? How do they plan to not just survive this, but actually regain their footing for 2026 and beyond?
Right, the remediation plan. They're really intensifying their actions. This means stepping up their audit, clinical policy, and payment integrity tools. Basically trying to protect customers and patients from unnecessary costs and identify waste or abuse in outlier coding and billing practices. They're also shifting to narrower networks and focusing on more discipline managed products, particularly within Medicare Advantage. That's a key move. Another big part of the strategy is scaling their AI efforts across health plan operations. The idea is to improve patient and provider service experiences and hopefully drive some cost savings too. Lastly, in Medicaid, they're actively engaging with state partners, trying to show them the need for immediate and more regular rate updates to keep pace with costs.
And given this intense focus on cost, what's their specific pricing strategy looking like for 2026? It sounds like it has to be aggressive.
It is. It's intensely focused on margin recovery. That's the phrase they used. For Medicare, remember their historical operating margin target was 3.5%. Well, that's been reframed now to 2.4%, partly because of the Inflation Reduction Act's impact on the Part D program, which, interestingly, resulted in higher revenue but no impact on earnings. So their new goal is to be in the lower half of this new 2.4% target range in 2026 and then advance further in 2027. Their Medicare Advantage pricing strategy for 2026 assumes a trend approaching 10%. 10%. That accounts for the acceleration we talked about and incorporates things like fee schedule changes and, frankly, higher yields from provider coding and billing practices. And this has led to, as they put it, significant adjustments to benefits for members.
Significant adjustments to benefits.
Yeah.
And what about strategic exits? Are they pulling out of markets?
Yes. They've made the difficult decision to exit plans that currently serve over 600,000 members. These are primarily in less managed products, like PPO offerings. That's a significant number of people who will need to find new plans. Now, in the commercial segment, Because renewals happen throughout the year, they can adjust pricing more dynamically, but they do anticipate these higher trends continuing into 2026 and 2027. They actually expect increased membership decline and more shifts into level-funded and self-funded categories because of these trends. For the individual exchange business, the ACA market, they'll be pricing far more conservatively for 2026, and they might even exit select markets if necessary. They're also very mindful of adverse selection dynamics.
Adverse selection. Can you quickly explain that one too?
Sure. Adverse selection is basically when healthier individuals decide a plan is too expensive and opt out. That leaves a higher concentration of sicker, more costly members remaining in the plan, which makes the plan financially unsustainable unless premiums go up even more, potentially starting a cycle. They're particularly watching this because of the projected expiration of premium subsidies across the ACA market. And finally, for Medicaid, they expect continued margin compression into 2026. Due to that lag between state funding levels and member health risk, they're even projecting a loss within the non-dual segment.
Wow. It really sounds like UnitedHealthcare is undergoing a massive, almost painful reevaluation. Okay, let's pivot now to Optum, their health services arm. How has their performance been and what critical changes are underway there?
Right, Optum. Well, their performance has also not met expectations, so similar story in some ways mirroring issues on the health plan side. The Optum CEO, Patrick Conway, echoed that need for humility and a deep analysis of key issues. They've launched their own agenda of change, starting with pretty significant leadership evolution, including a new CFO, a new CEO of Optum Health, a new CEO of Optum Insight, and they're bolstering Optum ARCs too. Now, Optum Health is experiencing the greatest pressures. They still believe steadfastly in value-based care's potential. They cite research showing MA patients in fully accountable setups are 20% less likely to be hospitalized, 11% fewer ER visits compared to traditional fee-for-service. But their 2025 earnings are approximately $6.6 billion below expectations, another huge number. About 55% of that shortfall, so $3.6 billion, is specifically in their value-based care business. And that's driven by a few things: the mix of enrollment, meaning more complex, dually eligible, underserved new patients coming in. Also, the accelerated medical trend we've discussed, physician and outpatient in Medicare, behavioral and Medicaid hitting them too. And crucially, underestimation of new members' risk status, alongside what they called suboptimal execution of the V28 risk model transition.
V28. That's the new Medicare Advantage risk adjustment model, right?
Yeah.
How big of an impact was that?
Exactly. That industry-wide shift to V28 effectively created an estimated $11 billion headwind over 3 years just for Optum Health. And they figure about $7 billion of that has already been realized through 2025, which, notably, is $2 billion and $1 billion more, respectively, than their initial estimates. So bigger impact than planned. Think about this. Their fully accountable value-based care business is operating at about a 1% margin in 2025. 1%. That's down from over 3% in 2024 and nearly 5% back in 2023. That's a steep drop. Interestingly, margins do improve the longer patients stay in their cohorts. For example, folks who joined in 2021 or earlier are generating an 8% plus margin, while the newer groups, 2024, 2025, are actually at negative margins. So that really suggests the challenge is primarily with onboarding these new, often sicker patients effectively into their models. So remediation includes a much more concentrated regional operating model with just 4 market leaders, shifting risk back to the original underwriters when necessary, and just being generally more disciplines and risk arrangements they take on. Their improvement plan has 4 key elements: improve clinical model consistency, focus on margin recovery. That includes ceasing arrangements for about 200,000 patients currently in PPO products they manage. Also, aggressively advancing operational disciplines. They expect almost $1 billion in cost reductions in 2026 from this. And finally, improving their fee-for-service care delivery. Long-term, they're still targeting Optum Health margins at 6-8%, with value-based care specifically at 5%. And they still insist they see significant growth opportunity for the decade to come.
Okay, so Optum Health is under pressure. What about the other parts? Optum Insight and Optum Rx.
Right. Optum Insight, their data and analytics arm, has not fully capitalized on this opportunity, according to them. Reasons cited include an unfocused product suite, lagging innovation, and a longer than expected impact from last year's huge Change Healthcare cyber attack that's still having ripple effects. So their 2025 outlook is adjusted downward by $1 billion due to slower recovery and pausing some portfolio actions. They are now actively recruiting talent specifically to develop next-generation AI-rooted products. That seems to be a big focus area now. Their contract revenue backlog, though, was still pretty solid at the end of Q2, $32.1 billion. And finally, Optum Rx, the pharmacy benefit manager. Client retention remains high there, which is good news for them. But earnings growth has been constrained by four main factors. One, the removal of those portfolio actions, that's roughly a $150 million headwind. Two, some issues in ancillary businesses, about $50 million. Three, the initial launch phase of their private label business, Nuvella, that's another $150 million or so headwind as it gets started. And four, the impact of GLP-1s, those weight loss and diabetes drugs.
Ah, the GLP-1s. They seem to be impacting everyone. How big a factor is that for OptumRx?
They quantified it as about a $160 million headwind for OptumRx. So yes, definitely a significant factor across the whole industry. Overall for OptumRx, they expect 2025 revenue growth of about $18 billion or 13%, but earnings growth of just over $200 million, which is nearly 4%. And that growth is primarily driven by low margin specialty drugs.
Okay, so after dissecting UnitedHealthcare and Optum's individual challenges, what do the consolidated financials tell us? What's the picture of the company's overall health, considering all these significant financial shifts?
Well, looking at the consolidated picture, UnitedHealth Group reported revenues of nearly $112 billion in the second quarter of 2025. That's actually a pretty robust 13% increase over the prior year, reflecting growth across both UnitedHealthcare and Optum. So top-line growth is still there. However, the adjusted earnings per share of $4.08 were definitely below the same period last year. And that's primarily due to those pricing and medical cost trend factors we've been discussing at both UnitedHealthcare and Optum Health. The second quarter results also included about $1.2 billion in what they call discrete items, one-offs basically. Over half of that reflects recognizing unfavorable impacts to their ACA exchange offerings, including accelerating anticipated second-half losses by booking something called a premium deficiency reserve.
Premium deficiency reserve. What's that in simple terms?
Think of it like this. It's like an insurer setting aside money now because they realize the premiums they've already collected for future coverage probably won't be enough to cover the expected claims for that period. It's anticipating a loss. The rest of that $1.2 billion is the settlement of several outstanding items, mostly from prior years. And looking forward, the full year 2025 outlook actually accommodates an additional $1 billion in potential similar items, totaling $1.6 billion for the year. Now, the consolidated medical care ratio, or MCR, increased to 89.4% in Q2 2025.
And the MCR, just to remind everyone, is the percentage of premium dollars spent on actual medical care.
Right. Exactly. It's often called the medical loss ratio. It shows how much they spend on claims and quality improvements versus admin costs and profit. A higher percentage means more spent on care, less left over. And their full year 2025 MCR is now expected to be 89.25%, give or take 25 basis points. Compare that to their initial midpoint estimate of 86.5%. That's a significant jump, indicating much higher medical spending relative to the premiums they brought in. On the cash flow side, though, things look a bit better. Cash flows from operations for the full year 2025 are expected to be about $16 billion, or 1.1 times net income. And in Q2 2025, cash flows from operations were strong at $7.2 billion, or 2.0 times net income for the quarter. They also increased their quarterly dividend rate by 5% back in June and returned $4.5 billion to shareholders through dividends and share buybacks in the second quarter alone. Oh, and notably, the company specifically stated its commitment to the pending Amedisys transaction. They view home care capabilities as foundational to value-based care, suggesting they still see opportunities for strategic growth despite the current pressures.
Okay, this has been a really deep dive into an organization facing, well, immense pressure and making some pretty dramatic recalibrations. But beyond these immediate financial shifts, what's the broader takeaway for you, our listeners? How might UnitedHealth Group's strategic pivot, focusing internally, focusing on technology, how might that fundamentally reshape not just their own future, but the entire health system and your experience within it over the next decade?
Yeah, that's the big question, isn't it? Look, while 2025 is clearly a challenging year, as they put it, for UnitedHealth Group, the company expresses really strong confidence in overcoming these challenges. You hear it in their tone. They expect solid but moderate earnings growth in 2026, with earnings growth then strengthening quickly in 2027 and pacing steadily upward in the years after that. They say this will be driven by a renewed focus on respecting pricing basics, basically getting the fundamentals right, advancing foresight acumen, which really just means improving their ability to predict future trends better than they did this time, and just better, more intense, more decisive overall management. The company is also accelerating investments in key areas like AI, those Optum Insight products we mentioned, and their broader fintech agenda, areas they believe have been underinvested but could produce remarkable performance. So, despite the current headwinds, their long-term vision remains very ambitious, anchored in technological innovation and operational discipline.
So here's where it gets really interesting, I think.
despite these significant financial recalibrations, despite all the complexities of the healthcare landscape, the company seems to be fundamentally refocusing on its existing portfolio of businesses, driving practical innovations and scaled AI applications. So the provocative thought for you to consider is this: how might this strategic shift emphasizing internal performance improvement and technology-driven care, how might that reshape not just UnitedHealth Group's future, but the broader health system and ultimately your experience within it over the next decade? Will these internal shifts translate into a system that's more efficient, more patient-centric, maybe even more affordable? That's the real test ahead.